Welcome back, guys. Today we're going to take a look at CDW Corporation. Now, this is a massive corporation that's in the IT space. They basically acquired a bunch of companies, and now they're just one massive company. So over the past 5 years, they've grown by 116%, definitely outpaced the S&P 500. So very strong performance. Their all-time chart looks absolutely amazing as well. Crazy all-time chart, to be honest. Market cap of 30 billion and a price to earnings ratio of 28. So not too high of a price to earnings ratio, but their growth has been slowing. Also, yeah, they grew by like 120% in the past 5 years, but in the past 5 years, their net income has definitely not doubled. So they've done this through multiple expansion, which is usually a sign that the company might be overpriced. Let's take a closer look. Looking at the financials here, they have had strong revenue growth from 14 billion up to 23 billion in 2022. Then it actually declined to 21 billion in 2023. So that's a bad sign. It could be related to AI. Maybe this company is falling behind in AI, and maybe that's why the revenues declined by such a substantial amount. Or maybe it's a weakness in the economy. That could definitely be a possibility. This could be just another sign of weakness in the economy. Yeah, even last quarter they declined by about 5%, and yeah, their margins are pretty stable, so it hits their net income. And yeah, their earnings per share was 8.2. The analysts are actually expecting 10 next year, which doesn't make any sense to me. They probably won't be able to do 10, especially with their latest quarter being not very good. But anyway, their basic shares outstanding, well, yeah, they've been buying back shares, so that's always a good sign. Means that they have capital to deploy. And their balance sheet is okay. They have had to take on debt to do acquisitions. So you can see the assets here. Between 2020 and 2021, they must have done an acquisition because their debt jumped quite a bit and their assets jumped quite a bit, and most of that is goodwill. You can actually look in here. Yeah, it's all goodwill, so our net intangible, because they bought a business, probably a brand as well, and that's why their goodwill jumps like that. Now, goodwill is kind of tough because you can't really sell it off um, if the brand deteriorates. Yeah. But yeah, you're gonna have the debt forever, so yeah, makes it tough. But we'll always have to factor in the debt into our model. In terms of cash flow, what are they doing with their cash? Well, like I said, they bought back stock. Even in 2021, they bought back 1.4 billion in stock, and they issued 2.5 billion in debt. So they actually issued debt and then bought back stock with it. Um, Maybe not the best move by management. However, yeah, I think in 2021 interest rates were really low, so maybe they were just taking advantage of that and levering up their balance sheet a little bit, buying back stock. I mean, I'm not really a big fan of this. I really don't like when management does this. They take out debt and then they just buy back their own stock, rewarding their own shareholders and incurring a massive debt for the future. And usually, buying back stock is a good way to prop up the stock price for the management in order for them to get their bonuses. So, not a huge fan of that. However, yeah, they actually do pay a dividend as well. Not a very high dividend in comparison to their cash flow. Taking a look at their stats, let's look at their margins here. Yeah, their ROIC is really high, 15%. That's very solid. Gross margin is okay, 20%. Does look like that's been going up. Also, their net margin has been increasing very consistently, from 3.5% up to 5%. Last quarter it was only 4.4. Yeah, because they had a bad quarter. And yeah, so pretty good signs in terms of that stuff. Anyways, let me check here. Yeah, so they make most of their money from corporate customers, and they make some money off of these other segments. Looks like every segment has declined year over year, except for the government segment. Yeah. So not a very good sign in terms of their revenues. You can see that they even compare this to different recessions, which makes me think that they think that we're in a recession right now. Not a good sign for the overall economy. But yeah, so a lot of times you can actually make predictions about the overall economy just by looking at numbers from the companies, financial statements, and it makes it a lot simpler to project what the economy is going to do. So this might be a sign that it's a better idea to stay out of the market, maybe go to like short-term treasuries. But yeah. And yeah, here you could see that they basically do a bunch of acquisitions. So even way back when they purchased a asset here, they acquire Burby Information, then they acquire a UK-based Kelway. They acquire a bunch of different businesses, and that's basically how they grow. Bunch of different small IT businesses. They just wrap it under the umbrella of CDW. I'm going to what the analysts think. Well, the analysts are projecting 10.12 in earnings per share for this year. I doubt they're going to hit that. They might be able to hit 9, but they're not going to hit 10. Not quite sure where they get this number, honestly, because their numbers last quarter were pretty bad and declining. So I don't know how they got to 10.2, but then they projected a 10% increase up to 11.1. So maybe they're projecting lots of stock buybacks, and maybe that would help them hit that. But yeah. And they're projecting 1.6% in their revenue growth and 6% moving forward from there. Probably going to be able to hit that, I would think. Let's actually check the stats and see if they're shorted at all. Short percentage is 2%. That's a decently high short percentage, but it's not like a red flag or anything. 2% is not too bad. Let's look at the spreadsheet here. I put the estimates down: buybacks of 500 million, net debt of 5.3 billion, discount rates of 10% because I want a 10% return on all my stocks, exit multiple of 22. Now I put 22 because they are in the IT space, and the IT market is still growing, and it's going to grow for a long time. So I think 22 is fair for this business, just because I think they have a long runway for decent growth at like 5%. And that's what I have down. I think that they'll be able to grow by 5% a year. In their earnings, even from 10.2, I don't think they're going to hit this number. It's probably going to be more around 9. And yeah, I think they'll be able to grow by 5% in terms of their gross earnings. And in this case, their fair share price being about 182 or 142, I'd probably put them at 160, somewhere in between this number, because of course debt doesn't have to get paid off right away, but at some point it will have to. And in terms of the revenue model, it's pretty similar story. I have their revenue growth at solid 6% and profit margin at 5%. Now, they have been expanding their profit margin, so I would expect them to get up to 6% and maybe even possibly 7% by the time we exit. And in this case, then we are looking at a fair share price of around $200 a share, which is still lower than their current price, so I would not touch the stock. I'm like, especially with their last year, they're with declining revenues, that's a bad sign. So personally, I think if I owned the stock, I'd probably get out of it, and I definitely wouldn't open up a position right now. It just seems like their growth is not justifying their current valuation, and especially with the last year that they had, it definitely doesn't justify their valuation. So I would personally like this stock to drop quite a bit before I get interested, and that's what I think. So let me know what you guys think in the comments, and make sure to hit that like button. I'll see you in the next video.